In today's tutorial, we'll be talking about what is PEEP and spread in forex market. So, in the forex market, a PEEP, sorry, in the forex market, a PEEP and spread are crucial concepts related to price movement and trading costs. So, first of all, let's talk about what a PEEP is. A PEEP, like I explained before now, a PEEP is the smallest price movement that a given exchange rate can make based on market conversion. Remember the last time I make some teaching about the lot sizes and change in price. That addition in price is what we call the PEEP. It's typically the last decimal place in the market in the exchange rate. For most currency pairs, one PEEP is equivalent to match this a price. That one digit added to the price is what we call a PEEP, which is 0.0001. But there are exceptions such as pairs involving Japanese yen, where one PEEP is 0.01. This does not have up to 4 decimal places. PEEPs are used to measure price change and expect profit or loss. It's a term used to express whether you make profit or loss. Maybe the market can go against your decision or can go in your favor, and that additional price is what we call the PEEP. So talking about the spread, and I also explained earlier about the spread is the difference between the bid and ask price. If a currency pair of a currency pair, it represents the broker profit and covers transaction cost, any cost at all. It covers it. Okay, let's look at an example. For example, if euro to USD pair has a bid price of 1.1200 and the ask price of 1.1205, the spread, which is by the time you subtract this from this price, the spread is 5 pips. A smaller spread is generally preferable for traders as it reduces the cost of entry or exiting a trade. This is one thing you look after when picking a broker. Spread, the amount of spread. Some brokers, the amount of spread varies among brokers. In summary, a PEEP is a unit of measurement for price movement, while the spread is the cost associated with executing a trade in the forex market. Understanding this concept is essential for effective risk management and trade analysis. So, certainly, let's consider an example using the euro to US dollar of what this PEEP spread is actually. So, let's talk about the PEEP example first. If the current exchange rate of euro to US dollar is 1.1200 and it moves to and the price moves to 1.1201, the change is 1 PEEP. Conversely, if it moves to 1.1199, the change is also 1 PEEP. Just 1 PEEP, just one digit are removed from that figure. In this case, each PEEP represents a movement of 0.001 in the exchange rate. So if we look at the spread example, if the euro to US dollar pair has a bid price of 1.1200 and the ask price of this, the buying price and the selling price now of 1.1205, the spread is 5 pips. It's 5 pips. That is just spread. Just by subtract. If you just subtract this from this, is 1 you get, right? That is 1 pips. By the time you subtract this from this, the spread is 5 pips. It's just the difference. To enter a long trade, which is the buy, you would execute it at the ask price of meaning to buy it to ask price of 1.1205. If you were to exit the trade immediately, you would use the bid price of 1.1200. That is if the broker spread is 5. By the time you buy, immediately you want to exit the trade, you already make a loss of 5 pips. The 5 pips spread represent the cost associated with entering and exiting the trade, and it varies with brokers. So this is where we have a pictorial example of the euro to US dollar selling price of 1.0992 and a buying price of 1.0994. So the difference between this price and this price is just 2 pips. The smaller the spread, the more liquid the currency. So it's just like we'll talk about the base currency and the quote currency. The buying currency is the base, while the other currency, the selling currency, is the quote currency. And this is the bid price below them, and this is the ask price below it. So by the time you subtract the ask price from the bid price, you just got 2 pips. And that is just what the pips and spread is all about. Thank you.